In this video, I'm going to show you how you can cash flow $4,000 a month net using the midterm rental insurance strategy. But I'm first going to show you how you can even acquire this yourself on pennies on a dollar strategically, the way we did 4 years ago, and how this is a gift that keeps on giving because we were able to acquire it in a certain way. And I call it the safe way. If you want to scale and have profitable returns in using the safe way, well, you'll see it. Safe stands for S being the strategy that we use, so strategy. A being the asset type, acquisition. A is how did we finance it, and E is the exponential returns we've been able to receive with being able to use the strategy. So I want you to remember that the strategy, the asset type / the acquisition, the financing, and then of course the exponential returns that we receive by using this strategy, right? So what are we talking about? Well, first of all, we're talking about acquiring a single family home strategically, but not just any type of single family home. We're going to talk about the type of asset. So we're going to focus on the A, and that is what we like to focus on is the single family with 2 entrances. It's not a duplex, it's a 4-3, and we acquired this one for $275,000, right? Now, the way we acquired it, we actually house hacked it and we put down 5%. So by putting down 5%, we were able to then only come out of pocket with, we'll just do the math real quick together. So 275 times 0.05, that's $13,750. Obviously, you factor in closing costs and another closing costs. A good rule of thumb, I don't have the CD in front of me, but the closing disclosure, but it's anywhere from 1 to 2% of the purchase price. So if we do that, let's call it 1%. Let's do 2% of that. 275,000 times 0.02. That's about 5,500. So 5,500 plus the 5% of 275. We'll put it right here. So that's 275,000 times 0.05 plus 5,500. All in, we're at 19,020. 19,250. Right? Closing costs are about 5,500, which I put here. And then we're about 13. I think we're just about 1350, right? So if you do that, 13,750, right? For the down payment, closing costs, a total of 1950 out of pocket. Now, here's my rule of thumb for all of you guys who are out there who are thinking of getting your license. It's not a requirement by any means, but it does help tremendously because this property for 275,000, getting 3% of the commission is 8250. 8250. Now, if you're licensed, typically you give 20% of that to your brokerage. At the time, it was at Keller Williams, so they ended up only keeping 80% of that, so that's 6,600. So we'll scratch that and turn it into 6,600. Now, I want to make sure that this does not go unnoticed because this is another way to actually make income by being a realtor when you buy your own deals. Not a requirement, but certainly can help. So now you take the 19,000, right, that you're supposed to pay at closing. You subtract the 6,600. So I'm doing math in real time so you can see the numbers. 19,250 minus 6,600. That's $12,650 that we needed to come out to own a 4-bedroom, 3-bedroom home. Now, another hack, right? There's 2 things. When we talk about the asset type, it's a 4-3. But one thing that you can tell your realtor, which is keywords, or you can do yourself, is when you're going on realtor.com, is you want to make sure that you're filtering through the keywords in law suite, right? What this is telling you is it's going to pull up things that have 2 kitchens, right? You can say 2 entrances, 2 kitchens. These are keywords that will help you find these kind of homes. And this home has a middle door, so it can go from anywhere from being a 3-2 to a 4-3. It's essentially like buying a duplex, but it's not a duplex, and you have more favorable terms for your lender And that's how we were able to buy this home at, again. If you're currently getting value from watching this video, you'll want to make sure you take a second and click below to grab the midterm rental insurance blueprint to help accelerate your process in being able to land these midterm rental insurance contracts with respect to your marketplace. Make sure you click the button below and grab it and continue on with the gems in this video. $12,650 down, right? Now, what's fascinating as well, another keyword you can focus on is the keyword furnished, right? So we actually bought this fully furnished. So we were able to buy this at 12K and make our money work for itself right away by using what strategy? We first started using, so the STR, we started with STR and then we turned it into an MTR, right? So the STR is the short-term rental. That's what that means. A short-term rental is aka Airbnb. The MTR is midterm rental insurance, which I want to talk to you about because it's very, very key. So what do we do? The asset type is 4 bedrooms. 4 to 5 bedroom homes is our sweet spot. So check mark there. The strategy, we use STR and MTR, check there. The financing, we use conventional loan, check mark there. And here's where the gift that keeps on giving. Okay, so there's a specific reason why we buy 4.3. Now at the time we didn't even know we were solving that kind of problem. But the thing is, this home's overhead was $1,950 when we first got it for the mortgage. Mortgage then went up to $2,100, right? Long-term rental rent in this market go for about $2,100, which means you'd be breaking even. So this is why we do STR, because the STR projections are around, just around, I'd say 5,000 for that area. However, it's high turnover, lots of cleaning involved, a lot of Airbnb. We did that for a couple years, and then we said, hey, listen, there's a better model out there, and it's catering to these insurance companies, right? So these insurance companies are here. They're like the State Farms, Allstate, you name it, Allstate, State Farm, that's the insurance company. And they have clients, right? Now these clients own homes that are just like this home. But when something happens to their home, like a tree falls on their home, right? Tree falls on their home, falls over, pipe bursts, sewage backup, they need to be temporarily relocated for 3 months. They come and file a claim with their insurance company, and their insurance company sends them to a home like ours. The reason they like these homes is because they're fully furnished, Wi-Fi is on, ready to go. Just pack your bags and move in. And they have a fence in the backyard. Ideally, this property doesn't. It's pet friendly. That's huge. And for that reason, we're able to accommodate this family. We're able to accommodate, I'll move this because of the light here. We're able to accommodate this family and at a premium, because we're offering a solution that's a premium solution, right? And so now you have this 4.3 that traditionally would rent out for $2,100, very similar to the mortgage for LTR, because this is the LTR rate. STR would do 5,000, and midterm rentals with insurance, working with insurance companies, you average 7,000. So now what's the number for that? I actually have this number right in front of me. Last year on this property, we grossed $66,804 using this midterm rental model. Mind you, this is like 4 years after, right? I'm not even factoring on the gross revenue that we made in 2022, 2021, etc., which was around the 40K, then 50K. Then we got the $66,000 using the MTR model. And the way it works is, that means on average, we're getting, so let's just do a quick Rolodex here. 7,284 in July, 7,284 in August, 7,770 in September, 3,156 in October, 6,685, and that's because it was on a contract, okay? We got this, and so when you're looking at the spread, that's a net take home of 4,442, 4,924, 4,218 on one home. We're able to get $4,000 a month because an insurance company is willing to pay for a family that's displaced at a premium product to pay for our overhead and then some, to be able to then allow us to be highly profitable and 100% occupied with less turnover, which is the biggest honestly pain point in the STR space is the high turnover and the guests checking in and them having a problem, then you needing to send someone, etc. All right. So that was the main key takeaway with this case study. But something came even to light that was even better. After 3 years, we decided to do a cost segregation study. And because we had done STRs, we were able to gross depreciate, or a gross depreciation for that property of $63,612. Now, if you understand cost segregation, it's essentially a cost segregation study is just forced depreciation on the assets because it's commercial, short-term rental. And in short, I mean, I could do a whole other video on that. That 63,612 is essentially if you made X amount of money, let's say you made $200,000 that year, that gross depreciation can be counted against what you made, which essentially shows that you made less. And if there's tax withheld that you did for the amount that you made, you actually get that money back. We were actually able to get fat check between 3 different properties. We got a check of $57,000, which is divided by 3. You could say that's about $19,000 per property, right? On the cost segregation. So that's the reason why I say exponential returns is we only have to purchase this once and it's cash flowing like this. And one thing to factor in that I left the best for last, the icing on the cake in all real estate. You ready? And for this, I'm going to wipe up all that I talked about here, but I want to show you a key number. This property we bought in 2020 for $275. That new value in 2024 is estimated to be $365,000, which means that at some point when we want, we can then go back into this property and get the equity by doing a home equity line of credit, which now that it's investment property, we won't have as much luck doing that, but we could still do a HE loan or a cash out refi, right? That's usually your best bet for that. You can do a refinance. However, we got a really good rate, so we'll have to be very strategic. However, lo and behold, we were able to use the right strategy, STR and MTR, use the right asset type in Find a 4-3 to be able to run this play, right? Because there's a big demand. Finance it creatively, and having a realtor's license was able to get $6,600 off the commission to only come down $12,650. And originally, when we acquired the type of property, we were key on making sure that it was furnished. And then the exponential returns is it's a model, it's a system that's once been implemented, we do every year. And also, not only is there appreciation, but we're able to also do the cost segregation, which you can only do once on this and reap the benefits. So on a $12,000 investment, we've not only made more than $150,000 in gross revenue, doing about $60,000 every year. The first year wasn't that much, that's why I rounded it to $150,000. It was closer to 40 grand. Then this year was 60 grand and $66,000. And then obviously the cost segregation, which is another bonus of another $19,000 there. So you're already upwards in the 180s. And then obviously the equity in there, which is about $100,000. This is way more than what we paid for because we only paid $12,000 to get into this asset. So this is the gift that keeps on giving. This is why we love to use Mr. Mental insurance strategy, working with corporations, essentially corporate housing, because it's essentially fast tracking your success and what you're able to take home. We don't want to just talk about what we're grossing. We want to talk about what we're actually able to take home and keep in the bank and then use to then reinvest into other properties, which is exactly what we've done to date. So with that, now you have a blueprint that you can utilize to maximize your return. Use the safe strategy, be strategic, use the hybrid model, short-term rentals combined with MTRs, acquire strategically 4 to 5 bedrooms home, fenced-in backyard, master on main, stay away from carpets, have a garage. It's a nice feature to have 2 separate entrances, so one day you could potentially turn it into a duplex when you step away, and you can also house hack the home. And financing, be creative. We've used second home loans, we've used conventional loans, we've done subject to deals, we've flirted with DSCR loans, but we didn't actually close on them. But there's a lot of different financing. Our goal is always to put less money down, understanding that we can always leverage to then have high cash flow, and as well as leveraging your license. If there's someone in your family or someone your partner of yours, whether it's yourself or your partner who can have that, this is always a big little chunk of change that comes back your way that makes the delta completely different. And then you can continue to scale, get your cost segregation. You can bank on the equity if you're in the right market that has equity. It's the icing on the cake, which you can tap into at a later time or at your convenience when it makes sense. So on that note, only one experiment away. If you got value from this, make sure you download the midterm rental insurance blueprint for insights on how you can actually make more with what you have. That is the reason we got into this space, is because the grass was greener, people had better markets, and we were looking at ours and saying, how can we get more from an asset that we already have? And that's the strategy that we turned to, and that we're so grateful that we turned into that strategy and continue to double down on it. If you got value from this video, make sure you check out the winning formula for cash flow midterm rental plus sub 2 strategy, the subject to strategy. Don't want to miss this video.